right after the chief investment officer for Morgan Stanley came out earlier this year and said the 60-40 model that BlackRock is now revising, said it's dead. Sell half of your bonds, the 40%, and put 20% into gold. Michael Hartnett said no, it should be 25% stock, 25% bond, 25% short-term treasury, 25% gold and silver. The lead metals guy for Bank of America just came out and said that he could see silver this year between 130 and 309. Jeffrey Gundlach, the bond king, came out and said 25% allocation to precious metals is not overweight. This is a dude that made his living, his moniker, his reputation on selling the antithesis of gold. And they sold at the beginning of the war because they saw the sell-off, and now they're reaccumulating again. So they think it's coming, and so they're buying again. Smart. They saved a little bit of money, sold at the top and buying again here, but they, to see it over $6,000 would not surprise me one bit at all. I mean, look, from a percentage standpoint, it's not that far away, We've seen a market that doubled in a year. To expect it to move up 15-20% in the face of massive inflation and higher energy prices and more military spending and a crazier world isn't that far, I think, of a stretch.
The traditional portfolio framework is starting to show real cracks as more institutional voices question whether bonds can still serve as reliable protection in a world shaped by rising debt, stubborn inflation pressures, and growing financial instability. What once felt like a stable, decades-long strategy is now being reconsidered in real time, and precious metals are quietly returning to the center of serious investment discussions. Andy Schectman highlights that this shift is no longer limited to gold enthusiasts or retail investors, but is increasingly being acknowledged by major financial figures who are openly challenging the long-standing 60-40 portfolio model. Instead of relying heavily on bonds, the conversation is shifting toward liquidity, resilience, and safeguarding wealth against an evolving monetary system. As gold and silver move from the sidelines into core allocation strategies, it signals a deeper loss of confidence in the old financial playbook. Now, we present the clips from Andy Schectman's interview. Before we continue, make sure to subscribe to the channel and turn on the bell icon for timely updates. Thank you and enjoy the video.
I think prices will go higher than people think possible, in dollar terms specifically. And it's important to note for silver as well, you're seeing high numbers as well. And the lead metals analyst for Bank of America is saying it can go to 309, I think was the number he said. But the point of it is that you're seeing all of the mainstream folks, not only at very high levels, not only endorsing higher prices of gold, but they're endorsing the highest allocations of it in your portfolio I've ever seen before. Higher than people think possible, higher than it is today. And in that article, I read that article too about the Swiss bank. They sold at the beginning of the war because they saw the sell-off, and now they're reaccumulating again. So they think it's coming, and so they're buying again. Smart. They saved a little bit of money, sold at the top and buying again here, but they, to see it over $6,000 would not surprise me one bit at all. I mean, look, from a percentage standpoint, it's not that far away, And we've seen a market that doubled in a year. To expect it to move up 15-20% in the face of massive inflation and higher energy prices and more military spending and a crazier world isn't that far, I think, of a stretch.
But now we're hearing the mainstream saying this as well.
Well,
what
first,
say you?
Michael Hartnett is, his newsletter is many thousands of dollars per year. It goes to the institutional traders. This is the same guy that came out and said, right after the chief investment officer for Morgan Stanley came out earlier this year and said the 60-40 model that BlackRock is now revising, said it's dead. Sell half of your bonds, the 40%, and put 20% into gold. Michael Hartnett said no, it should be 25% stock, 25% bond, 25% short-term treasury, 25% gold and silver. The lead metals guy for Bank of America just came out and said that he could see silver this year between 130 and 309. Jeffrey Gundlach, the bond king, came out and said 25% allocation to precious metals is not overweight. This is a dude that made his living, his moniker, his reputation on selling the antithesis of gold, an instrument that pays a yield. You're beginning to see it, but here's an interesting point. I have a dear friend. He's a good friend, and he also is a money manager that I do some business with at Morgan Stanley. And he wouldn't know a gold coin if it fell on his damn foot. And his chief investment officer, he is one of the biggest money managers in the state of Florida. He runs $4 billion. He's Kevin's brother-in-law. And he the chief investment officer of his firm is saying you should sell half of your bond portfolio and put it into gold. It hasn't trickled down yet. Michael Hartnett is speaking to the institutional traders. Jeffrey Gundlach is speaking to the institutional traders. So too is the chief investment officer of Morgan Stanley. They're speaking to the institutionals, not to us, and not even to the big guys that are managing $4 billion in the state of Florida. My point to you is that this is a whole different strata of people that are moving before the crowd. Could these be the people that are standing for delivery every single month? Could these be the people that have been every month for 18 months spending billions and billions of dollars when less than 1% of contracts ever move to delivery? Now we're seeing huge amounts. Could it be those folks? Maybe, probably, yes. And I think that you should listen to Michael Hartnett. He's a very smart dude. He's paid a lot of money to speak to the institutional traders. I try to read him as often as I can, and I've cited him a lot. And all I can tell you is that's not a small thing. But the thing of it is, you turn on any financial media, any that you can find, and not one of them will speak to this. Not one of them will. So this is way up at the insider level by the time it becomes obvious.
They were talking about gold for a little bit as gold was making new all-time highs like practically every week. It was getting mainstream attention.
Not in the
and
right
then
vein.
And then Larry Kramer said buy gold, and as usual, there was the reverse indicator because
Jim
of price.
Cramer, right.
Jim Cramer, that's right.
But none of them captured the most important thing. Buy gold, it's going up. Well, they would always talk about it being, well, could it be oversold? Could it, blah, blah, blah. But they never said buy gold really as much as they talked about its price. What they missed was who's standing for delivery every single month at levels that no one has ever seen before. These are the most well-informed traders on the planet. They've missed that. And then they piled on when it corrected, ignoring the important things. Speak to interest rates going up, and that's why gold's falling, ignoring that it went up 400 basis points over the last few years, and gold tripled. It's the mainstream financial media is the worst thing that ever happened to the investors in this country. They would get far better performance out of their portfolio by doing nothing other than listening, reading X, and watching YouTube. And that's the truth, because at least you get some truth and a more balanced position. Most of these folks have learned more and more about less and less. They become experts on nothing. They look at everything through a pigeonhole, and they don't have a global macro view. And to think that, look, the only thing constant in life, Michelle, is change. And things are changing. And whether or not people want to understand that and roll with the changes, that's up to them. If not, my opinion is they're going to get rolled by the changes, because the United States that we grew up in is no longer the United States that we grew up in. It's a different place with different ideologies, with different priorities, and a horrible balance sheet and a lack of trust. And the whole world foundation that has supported our exorbitant style of living through the accumulation of our debt and the willingness to take our dollars, starting to say, hey, that may not be such a good idea. And that's happening. And whether you want to realize that or not, I hope I've at least opened people's eyes a little bit, because I don't like to sit here and be the angel of doom and gloom. I don't want to be the buzzkill at the party. I don't talk this way in front of my friends, because I wouldn't be the buzzkill and wouldn't be invited back to the party. But at least this is cathartic. Well, it's cathartic for me to come here and tell you how I really do believe. And I think we are at the foothills of some very big changes, and you can see it if you open your eyes. Stop listening to your financial advisor, stop listening to the mainstream, and open your eyes and take accountability for yourself and do some due diligence for yourself. Don't listen to me, do some due diligence. Look what the big money is doing. Look at what Michael Hartnett is saying, and has been for a while.
And Mike Wilson of Morgan Stanley, it's the same.
Yes,
same
and Jeffrey Gundlach, and open your eyes and do a little due diligence, because if people worked as hard to save their money and invest it wisely as they did to make it, the world would be a much better place. So it'd certainly keep a lot more money.
The important point here is not only that gold is getting more attention, but that silver is now being pulled into the same institutional revaluation. This matters because the silver market is much smaller, so even a relatively small flow of large institutional money can have a big impact on price. Andy Schectman explains that some well-known market voices are now openly discussing precious metals allocations of between 20 and 25%, something that would have been considered extreme in traditional portfolio thinking. He also highlights bold silver projections mentioned in the discussion discussion, with potential targets ranging from between $130 and $300, reflecting how tight supply and rising demand could create sharp moves in the market. The key takeaway is that precious metals are no longer viewed only as a safety net, but increasingly as a strategic part of portfolio positioning. Now, let's return to the interview.
That this is a signal that we are about to see another big change in the global monetary system.
Yeah, it makes sense. This is why you're seeing the rise of parallel settlement systems, the SIPs, the cross-interbank payment system, the M-Bridge. This is why you're seeing gold being prioritized over treasuries, because I think it's much easier to have a neutral settlement system like gold that can't be sanctioned, can't be inflated away, and can't be taken if it's in your own possession within your own borders.
Why was the gold in the United States in the first place? What was the reasoning for that?
Well, after World War II, we said to all of the countries of the world, look, we're going to take over for the pound sterling. We're going to be the reserve currency. And you've lived through 2 world wars over there in Europe. So here's what you should do. You should give us your gold. We will hold it safely for you within our vaults, and then take the proceeds at $35 an ounce. We'll pay you for it. Take those proceeds and buy our treasuries. You'll help us, and we'll help you. You can earn interest for a non-interest-bearing asset. You don't have to store it within war-torn, Europe that's rebuilding. We'll keep it here for you. You'll make interest on what we're holding for you, and if you ever want it back, we'll give it back to you at $35 an ounce. And they were allies. It made sense. There was trust in a system. So in essence, the dollar was as good as gold because it was guaranteed to be returned at that rate. And as we got towards 1971 through the late 60s, when de Gaulle realized that we were printing more dollars to fund the Vietnam War and the Guns and Butter Initiative than we had gold behind it, and said, you know what, give us back our gold. And we did. And to your point, temporarily closed the gold window. Half of the gold that was held there was bled down. And a lot of people thought if he didn't do that, most of it or all of it would have been siphoned back by Switzerland, by the UK, by France. And I guess France got lucky. They got theirs before the window closed. Window has never opened back up.
Right. But what's the real story, Andy? What does this signal to you?
This is the same thing we've been covering for the last several years, Michelle. The repatriation of gold that goes hand in fist with the accumulation by central banks, another 1,000 tons last year. The central banks are buying gold. But more relevant, really, to the argument of counterparty risk, of trust in this country and of our institutions and our markets, it is the repatriation. And it started in 2017 with the Bundesbank making a very loud noise after 3 years of trying to repatriate their gold. Finally got them to send a good portion of it back. Followed almost immediately by the Bank of Hungary, Turkey, Poland, the Czech National Bank, Bank of Austria. All of these banks did the same thing. Give us back our gold, please. From the New York Federal Reserve, from the Bank of England, which gave direct access to the COMEX and to the LBMA. So when we talk about Germany, we talk about France. India is another big one, brought back all of their gold, a ton of it from the Bank of England. Again, I think the message is very simple. Nations that once trusted dollars, once trusted the LBMA, once trusted the COMEX are moving into metal that they can hold themselves and foregoing the convenience, prioritizing lack of counterparty risk. It's very logical to me, and also logical that they would want this to fly under the radar. The U.S. would, because I think it's an indictment. It's an indictment of the system that has existed for a very long time. The only reason you would want to bring it back is you don't trust the system any longer, because it's certainly more convenient to have your metal specifically where the 2 biggest markets on the planet are the COMEX and the LBMA. You know what? We'll forego that. Give it back. Thank you very much. Not only are we seeing lack of trust in things like the LBMA and the COMEX, but look, you're seeing less oil being valued in dollars, which means less money being put into treasuries, and that money is going into things that can be held, I believe, because we crossed the Rubicon by sanctioning and, in essence, confiscating the Russian forex reserves and their treasuries, their bonds. You can't be judge, jury, and executioner and walk around the world the way that we do with a stick and sanctioning and doing things that are you could say provocative at the very least. The world is prioritizing physical possession over their willingness to trust us. And you can see that across the board. Countries across the board do not trust us the way they used to. They don't trust us. They don't trust our markets. They don't trust our judicial system, our electoral system. They don't trust our geopolitical agenda. They don't trust our politics. They don't trust us anymore. It's a real shame because we stood on a very high moral ground, moral high ground after World War II that we trampled upon, and we continue to do so. Add into it fiscal irresponsibility and the willingness of a government like ours to impose sanctions unilaterally when the world looks at us and says, but you guys invaded Iraq 23 years ago under false pretenses, destroyed the country, toppled the regime, and you're still there. So where's the fairness in this? Now, I'm not making any statement on war. I'm not making any statement on Iraq or on Russia, Ukraine. But when you confiscate those treasuries and give it largely in the form of weapons to the Ukraine, the country they're in the midst of a war against, you crossed the line. If we maintain that same moral high ground in doing so, well, maybe the world will look past it, but they look at us and say, you can do this, you can be fiscally irresponsible, you can be completely ununified as a country and a mess in many ways and still think that it's okay. And I think the world looks back at us and says, no, it's not okay. So we better get our stuff back home. And when you realize that the COMEX sets the price globally, it is less convenient, but it also speaks to the rise of new exchanges in Dubai, in Shanghai, in Moscow, in St. Petersburg, the BRICS exchange that is being built, and all of the expansion of the Shanghai Metals Exchange, the first one just completed in Hong Kong. Relevant, why? Because when you settle imbalances in gold and take possession of gold from China, it must come out of Hong Kong. And we've talked about the next one being built in Saudi Arabia right now. They are working around it in a little by little manner. It's a big deal that I think is very obviously quiet by the mainstream media. They don't want this to be known because it shines a spotlight on, to your point, why would they take it? Because they don't trust us anymore. That's the bottom line, in my opinion.
Andy Schectman explains that a major shift is happening in the global financial system because trust between countries and financial institutions is weakening. One clear sign of this is that many central banks are bringing their gold back home instead of storing it in places like the New York Federal Reserve or the Bank of England. Countries such as Germany, India, Turkey, and others are doing this because they no longer want to rely on foreign institutions to hold their wealth. Instead, they prefer to physically control their own gold to avoid counterparty risk, which simply means the risk that someone else may not return or guarantee their assets. He says this is different from the past, when the US dollar system was trusted after World War II and countries felt safe keeping their gold abroad. But over time, especially after financial crises and the use of sanctions, that trust has weakened. Because of this, more countries are moving away from relying on Western financial systems and are also exploring alternative trading systems outside the dollar system. Schectman's main point is that gold is becoming more important again because it is a neutral asset that no one can freeze or control. In his view, this trend shows that countries are becoming more cautious and want real physical control over their wealth rather than relying on promises from financial institutions.